say the internet is so revolutionary that the usual rules for valuing a stock, such as revenues and earnings, no longer apply.
Over and over again, scenes like this one would play out at the dot-coms, making paper millionaires out of many of them.
Well, ultimately, you run out of greater fools.
After what they are already calling Black Friday, they are counting up the damage on Wall Street tonight.
In the spring of 2000, the stampede reversed.
And sent the Dow and the Nasdaq plummeting. It was the worst single-day point loss ever for both exchanges.
AI valuations in 2025 are now bigger than the dot-com bubble ever was. In this video, I'll break down why AI Mania is looking like 1999 all over again, the insider selling you need to know about, and the key catalysts ahead. As an actuary, I spent over a decade analyzing risk for Fortune 100 companies, modeling tens of billions of dollars in revenue. I take that same probability-based, risk-focused mindset into the markets, where my trading focuses on clarity and risk control over noise and hype. Now, imagine stepping back into 1999. Everyone is talking about the internet. IPOs are exploding and valuations are sky high. Fast forward to 2025 and it feels like history is repeating itself. But this time it's AI. Nvidia alone now makes up nearly 8% of S&P 500. Add Microsoft and just two companies hold 15% of the entire index. A concentration we haven't seen since Cisco and Yahoo were carrying the market 2 decades ago. Back then, the narrative was if it has .com in the name, it's going to the moon. Now, if it's an AI play, it's untouchable. And we know how the previous story ended. This week, AI euphoria took over every headline and trading forum. You couldn't open Twitter without seeing posts claiming AI agents will replace 90% of software, or threads listing the must-own AI stocks for the coming revolution. If you're feeling a little deja vu, you're not alone. It's the same, this time is different mindset we saw back in 1999, right before the Nasdaq dropped 78%. But sure, this time, the laws of valuation apparently no longer apply, right? Let's call it what it is. AI has become the new religion of Wall Street. Nvidia is the high priest, Microsoft is the bishop, and Palantir is the upstart prophet promising salvation. And just like all religions, faith trumps logic. Palantir, for example, is trading at a trailing PE of 690. Yes, 690. That's not a stock valuation. That's a lottery ticket masquerading as an earnings multiple. Tesla too is getting swept up in the AI halo. Negative earnings growth doesn't matter. Musk Motors robotaxi, and suddenly every retail trader wants to mortgage their house to buy call options. This isn't investing. This is blind faith with leverage. While retail is piling into AI stocks like they're the last lifeboat on the Titanic, insiders are quietly heading for the exits. A staggering almost 90% of insider transactions are sales. Only 11% of companies are seeing net insider buying. This is the lowest level ever recorded. Institutions are no better. Over the past 4 weeks, they've dumped $8.5 billion in single stocks and ETFs. Last week alone, the outflow was $800 million. Meanwhile, retail has been net buyers for 30 of the last 32 weeks. This is the same setup we saw in late 90s. Insiders cash out, institutions hedge, and retail is left holding the bag. But don't worry, you'll still have that AI branded bag to carry your losses in style. Continuing this narrative, the S&P 500 price to peak earnings ratio now stands at 26.5. This is the highest since 2000 and 54% above historical median. It's a sign that valuations are stretched to levels that echo past bubbles. To put it bluntly, the market is priced as if earnings growth will never slow. Recessions are a thing of the past, and AI will solve all human problems, including the looming risk of your portfolio when the reality finally bites. And options markets? Forget about it. 68% of all option trades are now calls. A speculative frenzy that's just shy of the meme stock mania of 2021. Open Doors options volume recently equaled 298% of its market cap. That's the kind of stuff you see at the top, not the bottom. Now, here's the cherry on top, the Buffett indicator. We discussed this a few weeks ago, but it deserves another look because it's now more relevant and alarming than ever before. Back in 2000, the total market cap relative to GDP hit 150% before the crash. Buffett famously said, "When this indicator approaches 200%, investors are playing with fire." Well, folks, we're not approaching 200% anymore. We're sitting at 213%. This isn't just about playing with fire. It's a clear warning that valuations have reached overheated levels. This is one of the most reliable long-term valuation measures we have, and it's telling us the stocks are more expensive relative to the economy than at any point in history. You can feel the retail euphoria everywhere. On Reddit, people are bragging about big returns on Nvidia calls. On Twitter is threads about the next AI unicorns. Is the same psychology that powered GameStop and AMC. Except this time, it's happening on trillion-dollar stocks. The logic seems to be, if it says AI, it can't lose. And that's exactly the kind of thinking markets love to punish. Meanwhile, institutional investors are on the other side. Bank of America data shows they've been steady net sellers while retail keeps buying. When the smart money and the dumb money are on the opposite sides, history tells us how that usually ends. None of this means AI isn't real. Just like the internet in the 90s, AI will transform industries. But investors forget that the internet didn't stop being revolutionary after the dot-com crash. It just took years for valuations to catch up with reality. Nvidia might be a great company, but when it's worth almost 8% of S&P 500 by itself, you have to ask if the market has gone from optimistic to delusional. Right now, we're in a market where greed is driving everything. Fundamentals are optional, and insiders and institutions are quietly selling while retail loads up on calls, thinking they're about to retire early. The parallels to 2000 are impossible to ignore. Clear signals that history could repeat itself. And the Buffett indicator is flashing one of the strongest warnings we've seen in decades. The AI trade is still in full force, and momentum might carry it higher, but the setup is fragile. One earnings miss, one hawkish comment from Powell, and one hot inflation print, and this whole narrative could shift overnight. The market is priced for perfection, and if history tells us anything, perfection rarely lasts. To keep this video focused on the bigger macro picture, I'll be covering all the charts and technical analysis in my weekly newsletter. So if you're not on that list, make sure you're subscribed. You don't want to miss the potential plays and the trade setups I will share there. The link is below and it's completely free. Now, let's look at the key reports that could impact market sentiment next week. On Monday, we don't have anything scheduled. On Tuesday, we have advanced US trade balance in goods, retail and wholesale inventories, Case-Shiller home price index, consumer confidence, and job openings. On Wednesday, we have ADP employment, GDP, pending home sales, FOMC interest rate decision, and also Fed Chair Powell press conference. On Thursday, we have initial jobless claims, employment cost index, personal income, PCE, and PMI. On Friday, we have employment report, unemployment rate, hourly wages, US manufacturing PMI, ISM manufacturing, construction spending, consumer sentiment, and also auto sales. Shifting from the macro to earnings, here's what to watch. On Monday, we have Waste Management, Whirlpool, New Gold, and more. On Tuesday, we have Visa, PayPal, Boeing, Spotify, UPS, Starbucks, Seagate, United Health Group, SoFi, Merck, and more. On Wednesday, we have Meta, Microsoft, Robinhood, Qualcomm, Lam Research, Ford, Ultra, and many more. On Thursday, we have Apple, Amazon, Coinbase, Reddit, MasterCard, Roku, Cloudflare, Cigna, AbbVie, Roblox, CVS Health, and many more. On Friday, we have ExxonMobil, Chevron, Regeneron, and more. Please pay close attention. This week is looking extremely packed, and every day will be important for the markets. And if you found this video entertaining and valuable, please hit like and subscribe. If you don't want to miss out on the chart breakdowns, technical analysis, and breaking news I share throughout the week, make sure you've subscribed to my free newsletter. I send it out a few times a week with detailed macro coverage, chart breakdowns, and potential setups. The link is below and it's completely free. Thanks for watching, and I will see you in the next one.